All right, so once I know it's a great business, once I know it is fundamentally undervalued, the last thing I look at is I look at the charts. And I always like to enter when the price is at a strong level of support. So remember that a price, or rather a stock price, moves in three phases, right? It could be on a downtrend phase. We call this a downtrend phase, an uptrend phase, or a sideways consolidation phase. So the first thing is to be aware which phase is it in. Now, on a downtrend phase, you would recognize it by seeing lower highs and lower lows. So again, on a downtrend phase, it moves like that. Like this wave pattern over here. So it makes lower highs and lower lows. Okay? Now, in general, when the stock is on a downtrend, in general, I don't like to buy on a downtrend. Because on a downtrend, it could keep going lower and lower and lower. But there are exceptions to this rule. There are times when if I feel that it's on a downtrend, but it is at the extreme bottom of the downtrend, it's like a rubber band being stretched, and I think it's going to snap back up, I may enter right at the bottom of the downtrend when I see that the market is very oversold. And when the price has dropped historically to a low. So what do I mean? For example, when I look at a stock, for example, I look at McDonald's. And if I look at the last 20 years or the last 10 years of McDonald's, I notice that the biggest drop it has made has been, say, about 30%, right? That's the biggest drop, right? So the moment it kind of like drops all the way down to 30%, I know that, okay, we are somewhere near the low. It could go lower, but we're not too far away. And so in those instances, when I see the price has really dropped to the extreme low, I may buy right there at the low of the downtrend to catch it spring back up that way. So that is an exceptional time when I may buy on a downtrend if it is deeply oversold at the low of the downtrend, buy to catch it as it springs up. Okay? But generally, I avoid downtrends unless we have that scenario. Okay, so in the event of, for example, the COVID crash that we just went through, many of you would know watching my YouTube videos, and those of you in the Ultimate Investors Playbook mirroring my investments, you know that I jumped in right at the bottom. All right, so even though it's a downtrend, I jumped in right at the bottom of the downtrend to catch the reversal. And the reason is because after studying bear markets for the last 20 years, sorry, not 20 years, for the last 80 years of bear markets, I noticed that the average bear market is a drop of 36%. Okay, I mean, it's gone as low as 55%, but the average is a 36% drop. So the moment the market was down 36%, I knew that we were somewhere near the bottom, so I started buying aggressively to catch the bounce. And indeed, it was the bottom and it bounced up, and that netted us a lot of profits. Okay, so generally, that's what happens during the downtrend. Now, my preference is obviously when it's on an uptrend. Now, during an uptrend, again, the price doesn't go up in a straight line. It goes through wave patterns, right? Wave up, wave down, wave up, wave down, wave up, wave down, and it continues. So you've heard me say this many times before. It's like breathing out, breathe in, breathe out, breathe in, breathe out, breathe in. So on an uptrend, when do I want to buy? I never want to buy during the breathing out. Okay, I never want to buy during the impulsive wave. I want to buy during the corrective wave or the breathing in. So I always like to wait for the price to drop, right? To drop to a level of support, a strong level of support. And oftentimes I use the moving averages as support levels. Again, I can use this on many time frames. I can use it on a daily time frame, the weekly time frame, or the monthly time frame. So no worries about that. We'll go more into detail in a short while. Okay. Now, the third phase is that the price could be in a consolidation or going sideways, like so, right? Goes up, comes down, goes up. So it's a sideways pattern. So whenever I see a sideways pattern, I like to buy the moment it hits the support level. Okay, so the price goes down, hits the support, I'll buy a bit there, and I'll keep buying at the support level. So to summarize, when do I like to buy? I like to buy when the price is making a dip on the uptrend, right? You can see dip, dip, dip. Whenever it dips to the support, that's when I like to buy. Or the price is at the support level in a consolidation, right? It's going sideways and I buy near the support levels. Or if the price is reversing into a new uptrend. So from the downtrend, right, making lower highs and lower lows, when I start to see higher highs and higher lows, right, new highs and new lows, I like to get in to catch the new uptrend. And the fourth time which I buy, which is more rare, is I buy on a downtrend, but right at the bottom of the downtrend, when I feel that it is oversold and it's like a rubber band, and getting in before it snaps back up. All right, so let's take a look at some good examples. All right, so the first instance that I like to buy is when the price makes a dip on the uptrend. So what I want to see is I want to see an uptrend. I want to see higher highs and higher lows in the price action. I want to see the wave pattern, right? So wave up, wave down, wave up, wave down, wave up, wave. I want to see that wave pattern. So you can see in this example, Apple, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So I want to see this waving up and down pattern, right? And I want to see that the moving averages are in sequence from the smallest moving average to the biggest moving average. So in this case, I'm using the blue line, the 50 moving average, the green line, which is the 150 moving average, and the red line, which is the 200-day moving average. Okay, these are all simple moving averages. Now, notice I'm using daily candles. Okay, so I can look at daily candles, weekly candles, or monthly candles, right? I look at all three time frames, and I choose the time frame where the moving averages are the most clearly in sequence. So sometimes if the daily candles, the moving averages are jumbled up, I will then look at the weekly candles instead. And if the weekly candles are also jumbled up, I look at the monthly candles. So I keep going to a higher time frame until I see a clear trend in the moving averages. And again, I'll show you some examples later on. So in this case, you can see that I'm at the daily candles, and moving averages are nicely in sequence, right? The 50 is above the 150 and it's above the 200. So it's a clear uptrend. And again, notice the pattern. Every time the price goes up, right, it comes back down near the moving averages, right? So notice that for Apple, it tends to come down and find support at these moving averages, okay? So during a shallow retracement, it finds support at the blue 50 moving average. At a bigger retracement, it finds support at the green or the red moving averages. So as long as the price retraces to one of the moving averages, I start adding shares. So when it goes to the 50, the blue line, I add some shares. If it breaks and goes to the 150, I add even more shares. If it goes to the 200, I add even more shares. So every time it goes to a support level, I keep adding more and more shares. So remember that for investing, you never buy at one time. You buy in stages. You average in. So if I'm buying $100 worth, I don't buy $100 at one time. I buy $20 or $25 worth of shares. And if it goes to the next level of support, I buy the next $25. I keep adding in till I get a really good entry price, till I get as close to the bottom as possible. But knowing that we can't always catch the bottom, all right? So looking at this chart again, when would we buy, right? So this would be a buy point over here, right? Because after the wave up, comes down, hits the moving average, you buy there. Goes up, hits the moving average at the 200, buy there. goes up, hits the moving average, buy there, buy there. So as long as you buy near the moving averages after a retracement, all right? Now you could buy here as well. Yeah, you could also buy here as well. Make sense, right? So again, on the daily candles, a confirmed uptrend is when the 50 moving average is above the 150 and the price is above the 200 moving average. Okay. Now, question, would I want to buy here at this point? No. Why? Because you can see it's a wave up. We never want to buy on the wave up, and it's far from the moving average. So always wait for a wave down, buy at the support. Now, do I want to buy over here? No. Why? Because again, it's a wave up. Never buy on a wave up. Buy on the wave down, hitting a support, and buy at the support. Do I want to buy here? No. Again, it's a wave up, right? So wait for the wave down, near the support, and buy there. Okay, let's go back to our Microsoft example. So earlier on, we calculated that Microsoft's intrinsic value is about 199. So I drew this green dotted line to show the intrinsic value. And currently the price is here at 188. So fundamentally, it is slightly undervalued, right? So based on valuation, yeah, we could buy it. But personally, I like to buy it when it's at least 20% undervalued, so I get a bigger margin of safety. But looking at the chart patterns, would I buy based on the chart patterns? So first, I look at the daily candles. Again, let's look at daily, weekly, and monthly. Okay, so let's go to daily candles. You can see on the daily candles, it is on an uptrend, right? So the 50 moving average is above the 150, above the 200. So nice uptrend. Next question. On an uptrend, remember wave up, wave down, wave up, wave down, wave up. We want to buy on a wave down. When it waves down, retraces to a strong support level. So based on the charts, where do you see is a strong support level? Okay, so you can see historically, right, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So you can see that this orange line, which is the 100 moving average, has been a support. You can see the support there, right? Now, on the daily candles, I only want to buy only if the price is near the 50 moving average or lower. So you can see that right now, it is not near the 50 moving average. The 50 moving average, the blue line, is about 175. Okay, so I'm not going to buy it until it's 175 or lower. Okay, now even then, I would even prefer to be even lower because I can see that historically, this orange line, the 100 moving average, is a stronger support. Can you see it over there? Right. So in other words, where would I like to add more shares? Okay, ideally, I would say 175 is the maximum I would pay, but I would like it to come down to this orange line, the 100, at about 170. Okay, because you can see that this has been a stronger support. Now, I can get a different perspective by zooming to the weekly time frames. Okay, so on the daily time frame, I'm looking at the 1-year chart. On the weekly time frame, I'm looking at a 5-year chart. So let me go to weekly candles right now. Now notice something interesting. Now that you look at the weekly candles, you get a slightly different perspective. Okay, why? So notice that on the weekly candles, whenever the price made a small retracement, it found support at this red dotted line. Can you see? It always finds support at the red dotted line, which is the 20 EMA on the weekly candles. So currently the price is far away from the 20 EMA, which is the red dotted line. So you can see that based on the red dotted line, it will be about 170. Hence, like I told you, I'll only want to buy it at 170 because that tells me that historically, that was a support level. But during a big retracement, like during the COVID-19 crash, you can see the price goes all the way to the 50 moving average on the weekly candles. So which means that if I wanted to get an even better deal, where would I want to buy? I want to buy at the blue line, which is 155. There we go. So you understand now? So this is where I identify my buy points. Okay? So let me summarize what I'm saying. So what I'm saying is right now we are at 188. We are undervalued, but I want to get a better deal. So based on the historical chart patterns, I can see that when it comes to the red dotted line at 170, right, that is a support level. I want to add it at 170. But if you can have a bigger drop to 155, ooh, that's even better. I'll buy even more. Okay, so my personal preference for adding shares is between 155 to 170. There you go, right? Now, if you want, you can even look at the monthly candles to get an even bigger view. So now I go to the 10-year monthly candles. All right, and you can see on the monthly candles, right, the support is also at the 20 EMA. Can you see? Right, which again, it's probably at about 145. There we go. So now I've got 3 levels of buy points. At 170, I'm going to buy. 155, buy even more. 145, buy even more. So those are my buy points. All right. Secondly, sometimes you may find that the stock is not on an uptrend, but it tends to be in a consolidation pattern going sideways. Now, when it's in a consolidation, the moving averages are pretty useless because the moving averages tend to crisscross each other and they don't act as good support levels. Moving averages are only useful when it's clearly trending up or clearly trending down, right? So in a consolidation, we draw the support and resistance levels, and we like to add shares whenever it is near the support level, okay? So let's take a look at an example right now. All right, so a good example is Yum China, which is also a core stock in my portfolio. Incidentally, Yum China is not a Chinese company. Yum China is a US company that owns the franchise rights to run KFC in China, right? So the intrinsic value that I calculated is about $53. And you can see that for quite a while, for the last 1 year, it's been really undervalued, right? It's been selling undervalued. And you can see that it was in a consolidation, right? You can see it going sideways, literally going sideways for about a year. And I loved it, right? Because at sideways, I keep accumulating shares at the support level, okay? So where do you think I bought shares, right? Every time it was near the support level, about $40 to about $42, or rather $41. Between 40 to 41, I would, buy shares, buy shares, buy shares. So I keep buying at the support level, all right? And now you can see it has broken out of the consolidation. Looks like it could be starting a new uptrend. So very, very profitable on this one, buying at the support. And again, notice what I said. In a consolidation, the moving averages are not sloping nicely. They're crisscrossing each other, as you can see, and they're pretty useless, right? So you depend on the support levels to add shares. So in fact, you can see in my portfolio, I own a stake in Yum China over here. You can see below my Yum China shares, and you can see the average price, this is the average price I bought at, was about $42, right? And right now it's at $51, and that gives me a nice $6,000 profit on Yum China, buying at the support levels, right? Another example is Johnson & Johnson. So for Johnson & Johnson, again, you can see that on the daily candles, right? Looking at the daily candles, all right, you see it's on a big consolidation. Can you see that? Right? There's a resistance over there, and there's a support, right? So it's going sideways, and like I said, when it goes sideways, the moving averages are crisscrossing, that it doesn't act as a support, right? So we depend on the support and resistance. So the intrinsic value of Johnson & Johnson is about 133. That's the intrinsic value. All right. In fact, I've got two intrinsic values, a pessimistic one and the optimistic one at about 151. Okay. So to be safe, I like to buy when the price is below my pessimistic intrinsic value. Okay. So currently, would I want to buy Johnson & Johnson? No, because currently it's at 146. It's at 146 here, and it's not that undervalued, right? I want to buy it when it's below 133, which is my pessimistic intrinsic value. I want to buy it at below 133. So where do you think I bought it, right? That's right. I bought it whenever it was near the support level, all right? Between 122 to about 125, that was when I was buying lots of shares. And now that is up to 146 again, holding on to some pretty good profits. Now, so you can see that on the daily candles, it's going sideways. But again, you can look at a higher time frame to get a different perspective. Let's look at the weekly candles. Okay, now you can see on the weekly candles, you notice more of the wave pattern, right? Wave up, wave down, right? Wave up, wave down, 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 right? You can see the wave patterns more clearly. And you can see that on the weekly candles, right, there tends to be a strong support at the green line, the 150, and an even stronger support at the red line. Can you see that? Can you see these support levels? So all the more, we are now at 146. I'm not going to buy 146. I'm going to wait for it to come down to 133 or lower, where there's a strong support, and I'm going to buy it there. So we always want to buy at a support to get a good deal. So when it rebounds back, we make a lot of money. We don't want to buy it when it's already going up. Make sense, right? Now again, sometimes when you find that a particular stock on the daily candles has a very messy chart pattern, like in the case of Google, you can see the chart pattern is really messy and it's really hard to find a support. What do? You go up to a higher time frame until it gets clearer. All right, so in this case, the daily candles are very messy. I'm going to use the weekly candles. All right, so going to weekly candles, you can see now it's a lot clearer. The chart patterns, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up. So you can clearly see the wave patterns very, very clearly. All right, and you can also identify clear levels of support. So you can see that for Google, for Alphabet, whenever it drops, it finds support at the 50 moving average. Can you see the 50, the blue line? Okay. And if it's a deeper drop, it finds support at the orange line. Okay. And if it's a very big drop like the COVID crash, boom, you can see it finds support at the 200 moving averages. So the moving averages act as levels of defense. When it hits the level of defense, it breaks it, it goes to the next level of defense. So based on this question, where would I buy Google? Where would I add Google, right? So right now it's at 1448. Would I want to buy it now? No, I wouldn't want to buy it now because I want to wait for it to come down to a support level. So I'm going to buy it only if it hits this orange line, which acted as support in the past at 1208. Okay, and if it can hit the red line at about 1087, that would be a steal. Can you see what I'm saying? So my ideal buy price is between $1,087 to $1,200 because those are where the support levels are. All right, so we've learned that we should buy the dip during the uptrend or retracement during an uptrend. In a consolidation, we buy the support level. Now, what if it's on a downtrend? So how do we tell it's a downtrend again? On the daily candles, when the 50 moving average, the blue line, is below the 150 moving average, or if the price is below the 200 moving average, which is the red line, it's a clear downtrend, right? So ordinarily during a downtrend, I don't like to buy shares because on a downtrend, low can get a lot lower. Okay, I want to wait for the downtrend to reverse back into an uptrend before I start to get in. So you can see from this chart that this was a downtrend, right? The 50 below the 150, right? Downtrend. So we avoid getting in. Now over here, you can see that the 50 moving average has crossed above the 150 moving average. Once the 50 is above the 150, and both moving averages are starting to slope upwards, it's a change in trend. So that's when you could start to add shares at this point, right? So buy when the reversal of trend signal shows the 50 crossing above the 150. So we add there. And again, once we add there and it keeps going up, we then wait for retracements to get in again, right? So after get in goes up, breathe out, breathe in, hits the support level, buy again. Then breathes out, breathes in, support level, could buy again. So we keep adding in once it's on a new uptrend. Okay. Now, like I said earlier on, will there be times when I do buy on a downtrend? Yes. So let me tell you the times when I may buy on a downtrend, right? Now, when a stock goes on a downtrend, there are two ways that can happen, right? So the first way is that on an uptrend, la-di-da-di-da, it goes into a downtrend in a gradual way. So it gradually goes into a downtrend like so. Okay. So when it gradually goes into a downtrend, you can see that the moving averages, they slowly slope up and they slowly start to slope down, and the 50 moving average crosses below the 150. That is what we call a measured change in trend. Okay. Now, but there are times when the price is going up and it suddenly drops into a downtrend drastically. And normally it's caused by a panic situation like COVID-19. When the price doesn't go down at a 45-degree angle, the price drops at a 90-degree angle, right? So it's kind of like the rubber band. When the price drops too fast, what happens? The moving averages do not have a chance to catch up to the price. So when the price drops very fast, you notice that the 50 moving average and the 150 moving average take a lot longer to cross over, okay? And the price is now very far away from the moving averages. So when the price is very far from the moving averages, what tends to happen? Again, like a rubber band, when you stretch it too fast, it tends to snap back. And that's exactly what happened during the COVID-19 situation, the COVID crash. The market dropped 90 degrees. So whenever I see the market dropping 90 degrees really fast, and it starts to drop to more than 30% below the intrinsic value, or more than 40% above the all-time high, I will start buying shares, okay? In anticipation that it has gone too fast down, it's going to snap back up. So again, like I said, on a downtrend, if it suddenly drops at a 90-degree angle and the price is more than 30% below the intrinsic value and more than 40% below the high, it is usually an indication that the bottom is near, provided it is a fundamentally good company. So when I see it drop 90 degrees and it hits an area of support, like you can see this is an area of support over here, all right? And it hits this support, I will start to buy right there at the support level before it even reverses into an uptrend. So I catch the low of the plunge, if you will, and I get in before that snap back up. So let me give you a recent example. A good example I can give you would be McDonald's, right? So you can see that McDonald's was on a very clear uptrend, like so, okay? And over here, this was the COVID-19 pandemic crash. And you can see it dropped 90 degrees. It literally dropped in a straight line. So when the price drops too fast, what happens? You can see that the price is very far away from the moving average. It's like a rubber band, right? So I know it's going to snap back, but exactly when is it going to snap back? So what I do is I look at history. If I go back to history and I go back to looking at the last 10 years, for example, I'll notice that during a big drop, right, during the big drop, like so, McDonald's would roughly drop to about, at the very most, 40% of the high before it bounces back, right? That's based on historical observations, okay? And so knowing that statistic, what do I do? And again, you can see when it dropped, the 50 moving average crossed below the 150 moving average. Now, the problem with a sharp drop is that by the time you wait for the 50 moving average to cross back above the 150, by the time you buy, you would buy it too late. You want to buy as low as possible. Okay, so in this instance, when I see a 90-degree drop and I calculated the intrinsic value is about 205 and it dropped to about 140. Okay, so the moment it dropped to 140, I said, hey, at 140, it's more than 30% below the intrinsic value. We're near the bottom. So I started buying at 140. Now, the moment I bought at 140, did it go up straight away? No, because you can't always pick the bottom. You're not always that lucky, right? So after I bought at 140, guess what? It dropped to 124. And I said, it's okay because I'll just buy some more. All right, and sure enough, very fast, the price snapped back and it's now back to about $200, 202. Okay, so these are instances where I will buy on a downtrend if it drops 90 degrees and it hits a strong level of support. Okay, now if I go back in history, okay, so for example, look at this situation. Over here, you can see that this is what we call a gradual change in trend, because it's going down 45 degrees. So it's a very gradual change in trend. So for these trends, I do not buy during the downtrend. I wait for it to change trend again, right? Excuse me. For the 50 to cross above the 150, I buy there to catch the new uptrend, because that's a gradual change in trend. But if you look at the recent one, it was not a gradual change. It was a sharp 90-degree drop. Okay, so in a sharp drop, either I start buying when it hits a strong level of support, or I buy once it drops more than 40% from the high. So you can see the high was 221. So if you take 221 and you discount that by 40%, that gives you roughly about 132, right? So at 132 thereabouts, I knew that historically it has dropped far enough. It's time to buy to catch the snap back up. Does this make sense? Okay, great. So you can see that I use many different approaches in deciding when to add shares. Now let me show you Facebook, for example. Oh, sorry, let me show you Alphabet or Google. So you can see, for example, that the last year or so, the price has been very choppy. Very, very choppy. Can you see that? So when you look at the daily candles, it's really hard to see a clear support because it's so choppy. And like I told you, what do I do when I see something like that? That's right, I go to a higher time frame. So from the daily candles, I go up to the weekly candles, where now you can see it's a lot clearer, right? Where you can see a clear support at the 50 moving average, and then another support at the 100 moving average and the 200. So this gives me a clue when I should buy. And for Alphabet and Google, as you can see, I'll probably buy at 1,002 to 1,264, which I mentioned earlier on. Okay, another example would be Facebook. Again, you can see on the daily candles, you can see that, you have the plunge, it's a bit choppy. So when it's choppy, I go up to a higher time frame of weekly candles, and I can see a clearer trend where you can see it's supported by the 50 moving average. And if it's a big one, it gets supported by the 200 moving average, the red line. So when it hits the red line over here at 160, I started buying aggressively to catch the next wave up. All right, so that sums up the 7 steps to value momentum investing. I hope you've got a clearer picture. So next on, we're going to do a couple of case studies where you see how I run through the 7 steps on different kind of stocks. I'll see you in the next part of the lesson.